JP Morgan just increased their SoFi position by 881% in one quarter. That's worth over $1.2 billion. And honestly, this isn't about the S&P 500 inclusion everyone keeps talking about. It's something bigger. And, well, most people are completely missing the actual story here. Look, if you're short on time or, not really interested in hearing some random guy on the internet ramble about stocks, here's what you need to know right now. SoFi has quietly crossed a threshold that changes everything. They're not a growth story anymore. They're not a student loan company anymore. They're a profitable, diversified financial institution with over 1,200 institutional investors piling in. And the technical setup suggests we're sitting at a consolidation point before the next move higher. The JP Morgan position? That's validation, not speculation. But if you've got about 10 minutes, let me walk you through exactly what's happening. Because, this is actually one of the cleaner institutional buying patterns I've seen in a while. A quick introduction for those who are new here. I'm DataCat, and yeah, that's actually what I go by now. Spent years as a very average analyst inside a Fortune 50 company, crunching numbers, help building model pipelines, sitting in meetings that could have been ended with a Slack message. The usual corporate thing. Eventually, I traded the corporate grind for, this. Lasers, mechanical keyboards, and talking to a camera in my apartment like a totally normal person when my cat is about to disown me. This channel's only about 4 months old now, so we're still pretty small. Every like and subscribe would mean a lot to me. And a quick warning, if I sound a bit too dull or awkward, that's just how I am. Cats are supposed to be graceful, but apparently I missed that memo. Anyway, SoFi. Let's talk about what's actually happening here, because the surface level narrative is missing about 70% of the story. So, on November 26th, we got the Fintech disclosure that JP Morgan now owns 46.8 million shares of SoFi. That's roughly 4% of the entire company. The media's running with the S&P 500 inclusion angle, which, fair enough, it's a good headline. But here's the thing. When you look at the actual mechanics of what's happening, this isn't a momentum trade. This isn't JP Morgan trying to front-run an index inclusion. This is a structural allocation based on a fundamental thesis. And honestly, that's even more bullish. Think about it like this. Cats don't pounce unless they're pretty sure they're going to catch something. We're lazy, we conserve energy. JP Morgan doesn't allocate $1.2 billion because they think maybe possibly SoFi might get added to an index someday. They do it because the business has fundamentally changed, and they want exposure before everyone else figures it out. So allow me to run some boring yet meaningful numbers briefly, and I'll walk you through what actually changed, because this is the core of the thesis. SoFi hit GAAP profitability in Q4 of 2023. Now, for those who don't live in financial statement land, GAAP stands for Generally Accepted Accounting Principles. It's the strict no funny business version of profit. Not adjusted EBITDA, not non-GAAP, not profitable if you ignore all the expenses we don't like, but actual profit, period. They've now been GAAP profitable for 4 consecutive quarters. Their trailing 12-month earnings per share is positive. This is critical because it checks the box for S&P 500 eligibility. But more importantly, it signals that the business model actually works at scale. Revenue growth in Q3, 36% year over year. They beat on revenue, they beat on earnings, they beat on guidance. And this is the part that's actually impressive to me. Their revenue diversification is accelerating. Financial services and their tech platform now represent about 50% of total revenue. A year ago, that was closer to 40%. Why does this matter? Because SoFi used to be basically a lending company with aspirations, personal loans, student loans, mortgages. Very cyclical, very sensitive to interest rates and credit conditions. Now they're becoming a diversified financial services company with a banking charter. The lending business is still there, but it's not the whole story anymore. They've got deposit growth, they've got their tech platform licensing to other fintechs, they've got wealth management, they've got their own brokerage, and not to sound too much like a corporate drone here, but this is exactly the type of business model that institutional investors love. Recurring revenue, multiple growth vectors, defensible moat through the banking charter, optionality on margin expansion as they scale. It's like catnip for fund managers. So now we get to the really interesting part, and this is where you can see the machine starting to move. As of the most recent quarter, SoFi has 671 million institutional shares outstanding. That's over 55% of the company, excluding any large individual holders. That number represented an over 10% increase in institutional ownership and about 20% more new investors in just 3 months. Now here's what I learned from my time on the inside. When you see this pattern, it's not random, it's mechanical. Here's what's happening. First, SoFi's market cap hit $34 billion. That crosses a threshold where it starts showing up in mid-cap index funds automatically. These funds don't have a choice. If they track the index, they have to buy. Second, SoFi now appears on growth factor screens. Revenue growth above 30%, check. Profitability inflection, check. Positive momentum, check. Quantitative funds that screen for these factors are buying automatically. Third, thematic fintech ETFs are increasing their allocations because SoFi's weighting in those benchmarks keeps growing as the stock price rises. This is the feedback loop that institutions love to ride. Stock goes up, market cap increases, more funds have to buy, stock goes up more, repeat. And we're still in the early stages of this. SoFi wasn't even on most institutional radars a year ago because it was unprofitable and trading under $10. Now it's impossible to ignore. The top holders? Vanguard, BlackRock, JP Morgan. These are not speculative funds. These are allocation managers. They're building positions because their models say this belongs in portfolios now. Okay, so everyone wants to talk about the S&P 500 inclusion, so let's address it properly. SoFi now meets every formal criteria. Market cap of $34 billion? Well, above the minimum of about $22.7 billion. Check. Profitability? 4 consecutive quarters of GAAP positive earnings. Check. Liquidity? About 50 million shares of average daily volume. Over 1 billion share free float. Only 3.5% insider ownership. Check. US. Based with a national bank charter? Check. SoFi is widely cited as a top candidate alongside Robinhood, Toast, and AppLovin. The precedent is there too. Interactive brokers just got added in earlier, showing the committee is willing to add fintech and brokerage companies. If it happens, historical data suggests about a 4% pop on the announcement and roughly a 12% cumulative gain over 3 months from forced index buying. That's based on Goldman Sachs research on past inclusions. But, and this is important, the S&P committee could wait. They could add it next year or the year after or never. They pace themselves. They're not obligated to add every eligible company immediately. Sometimes they wait to see if the profitability is sustainable, sometimes they balance sector weights, sometimes they just don't do what everyone expects. So here's my take, and I'm trying to be honest here. The S&P 500 inclusion is a nice bonus catalyst, but it's not the thesis. If JP Morgan was purely betting on an index inclusion, they'd use options or derivatives to get short-term exposure. They wouldn't accumulate 46 million shares. That's a multi-year position based on fundamental conviction. The S&P inclusion, if it happens, is like finding an extra treat in your food bowl. It's great, but you weren't starving without it. Okay, that's probably my worst cat analogy so far, but you get the point. Alright, so, let me nerd out on the charts for a minute, because the technical setup is actually pretty clean right now. SoFi closed at $28.49 on Wednesday. After the recent pullback, it's still up 73% year over year. We're currently sitting at about 82% of its 52-week range, about 13% off the highs. Now, the Golden Cross is still active and has been in place for 114 days now since June. That's a bullish longer-term trend signal. The stock's currently about 2% above the 20-day EMA, 1.2% above the 50-day MA, and 45% above the 200-day. So the uptrend is intact, but it's not overextended in the short term. Over the last 20 days, we've had 12 up days and 8 down days, which shows a slight bullish bias, but more importantly, it's consolidation, not distribution. The RSI recovered from oversold territory, now at 51 on Wednesday. That's neutral with room to run. MFI bottomed at 35 on November 21st, now at 46.8. Buying pressure is coming back. The MACD histogram has been rising for 3 bars, suggesting the momentum is turning back up. The stochastic oscillator is also forming a bullish crossover. Volume's been below average recently, about 56.4 million shares versus higher historical averages, but the on-balance volume is still rising. That's important. It means institutional accumulation is still happening, even as retail volume drops off. That's actually a bullish divergence. The price movement is now at the narrowest range in 7 days. That often precedes a breakout in either direction, but given the context of everything else, I'd lean bullish. The key levels to watch: support is around $27 to $28. That's the current price acting as support, plus the Fibonacci 50% retracement level at $28.12. If that breaks, next support is probably around 25.50 to 26, which would be a deeper pullback but still within a normal range for a stock that's up 73%. On the upside, resistance is around 29.80, then 30.30, and then the 52-week high at around 32.50. From a technical perspective, this looks like a stock that ran hard, pulled back to digest gains, and is now coiling for the next move. The momentum indicators are resetting from oversold without breaking the uptrend structure. That's exactly what you want to see in a healthy bull market. So, let me tie this all together because there's a lot of moving parts here. But apparently this is not financial advice. What we're seeing with SoFi is a confluence of fundamental improvement, structural demand from institutions, and technical setup that all point in the same direction. The fundamental inflection is real. This isn't hope-based investing anymore. Q4 2023 was when they proved the model works. Every quarter since then has been execution and expansion. Revenue growth above 30%, profitability sustained, diversification accelerating. That's the foundation. The institutional buying is structural, not speculative. When you go from unprofitable to profitable, when your market cap crosses 30 billion, when you start showing up on factor screens and index inclusion lists, you trigger mechanical buying from hundreds of funds that weren't allowed to own you before. We're watching that happen in real time. 671 million institutional shares, up 10% in one quarter, over 1,200 funds now long. That's not a momentum trade. That's reclassification. The macro backdrop is turning favorable. Rate cuts are coming. Lower rates benefit high-growth names by reducing discount rates in valuation models. And then there's the S&P 500 optionality. It's realistic for 2026, but it's not required for this thesis to work. If it happens, great. 10 to 15% bonus from forced index buying. If it doesn't happen immediately, the fundamentals and institutional demand still support higher prices. The feedback loop is the key here. Fundamentals improve, stock rises, market cap and liquidity surge, index and factor inclusion, institutional buying accelerates, media attention spikes, S&P 500 candidate lists, more institutions model it, more buying, higher price, stronger S&P case, repeat. We're in the middle of that loop right now. And JP Morgan's position tells us they believe this continues. Now, I need to be balanced here, because nothing ever goes straight up, and there are real risks. The biggest one is the credit cycle. SoFi makes personal loans. If unemployment spikes, if we hit a recession, personal loan losses could blow out. That would crush earnings, and the stock would get hammered. Their underwriting has been pretty good so far, but they haven't been tested in a real downturn yet as a scaled lender. Execution risk is real. Any guidance cut, any earnings miss, anything that breaks the narrative of consistent growth, the stock will get punished hard. Expectations are high now. The valuation assumes continued execution. There's no margin for error. S&P 500 timing is uncertain. The committee could wait years. Over-anchoring on this catalyst is dangerous. If people are buying purely for the index inclusion and it doesn't happen, you could see a flush. And just general market risk. If we get a broad market sell-off, high-growth names get hit first. SoFi is still a momentum stock in many ways. It's not a defensive value play. So, this isn't risk-free. Nothing is. I'm not sitting here telling you to mortgage your house and go all in. I'm just walking through what the data shows and why institutions are buying. Now, whether you personally want exposure to this, that's your call. I'm not a financial advisor. I'm just a former corporate analyst who happens to be a cat on the internet now. Honestly, I do spend an unreasonable amount of time napping and judging people, so maybe the name fits. Anyway, that's the SoFi thesis as I see it. If you made it this far, thanks for sticking around. This channel's still new, so if you found this useful, subscribe or whatever. I'll keep breaking down these institutional moves and trying to figure out what the smart money is actually doing versus what the headlines say they're doing. And DataCat out, stay sharp, and stay safe, and I'll see you in the next.